Okay, welcome to Technical Bootcamp Season 2, Episode 1, Accumulation and Distribution. So in Season 2, we're just going to be going over some of the more advanced ways to approach the concepts I showed you in Season 1. Today, we're starting with accumulation and distribution. We're going to talk through the different phases the market moves in endlessly, how the moves in the markets are determined by buyer and seller psychology, and how you can directly trade some clean accumulation and distribution formations in the market. So with that said, let's jump straight into today's class. So what you can see on the chart here is a visualization of a standard market phase, including accumulation and distribution phases. So accumulation and distribution is a concept really as old as time. It is baked into the nature of market movements in the same way that supply and demand is, okay? It's all about market psychology and the buying and selling battle. It was really popularized by Richard Wyckoff, which was probably about 100 years ago now. He was a trader and investor who brought to light the idea of market psychology, driving markets in phases of accumulation, distribution, markup, and markdown. So taking a look at the visualized chart here, we have boxes just before a downward move, or ranges just before a downward move. These are distribution phases, okay? So when you see a range before the market runs to the downside, that is known as a distribution. Then the boxes preceding an upward move are the accumulation phases. So these ones here and this one just here. These are accumulations. The downward moves in a market are under Wyckoff theory, but we don't have to name them this. I'm just going to do it for example's sake, are markdowns. So these phases are called markdown, okay? Just simply a phase where the market runs to the downside. And then the upward moves, like this one and this one just here, are mark up, okay? So those are the different phases a market moves in according to accumulation and distribution theory. Now, what are these phases? Well, we'll begin by saying this. The market only really ever runs in two different phases. It's only ever really doing one of two things. It's either building orders or releasing orders, okay? So by building orders, we mean building positions. Buy side or sell side positioning inside of a marketplace. Now, the accumulation and distribution phases are where these orders are being built. These sideways ranges occur because transacting is taking place over time at a low enough frequency not to move the market yet, but at a big enough frequency to release or build orders into the market, okay? So if we try to visualize essentially what is taking place here, we see selling is dominating the market. When we get to this level, we start to see buyers stepping in, but the buyers step in kind of a neat format, right? Rather than one big impulse which would blow the market through the top. Then once we have actually accumulated those orders, hence the name accumulation, we then see the markup movement which drives price higher, okay? So in these phases, we are building positions. We are building orders, either buy side or sell side. Buy side for accumulation, sell side for distribution. And then during the markup and markdown phases, we are releasing those orders into the market. We are seeing those buy orders or sell orders basically take control and dominate the market instead of ranging sideways. So those are the two phases that the market is always moving in. And the accumulation and distribution is always seen as a sideways range in the market. This is where those orders are being built. Markup and markdown are the directional movements in the market, and this is where orders are being released. So what exactly is an accumulation range then? Why does the market move sideways? Well, all an accumulation or distribution phase is, if we really break it down to its simplest form, is the time that it takes to build an order. So we've spoken in a previous episode of the Bootcamp, if you are up to date with this, and if not, don't worry, about executing large orders. Now, if you're an institutional participant and you want to enter an order here, let's say, so you want to start building a buying position, but the amount of money that you're trading with is incredibly high, so you're trading with tens of millions of dollars that you're trying to get into a buy-side trade here. Well, we have a problem. That is going to be a difference or differential between the buyers and the sellers available at a given price in the market. Now, when we add buys to a market, this is an increased demand. If you try to buy a lot of orders here, you need someone to transact at the other side of the market with you. Someone will at this level for a certain amount of money. However, if your order is really big, there's only going to be a certain amount of money here to take the other side of your trade. So only a portion of your trade will be executed there. Then the order is going to be sent to essentially whoever will take the next bid. If you're trying to buy at, let's say, 1.36, maybe the next seller won't accept less than 1.362. And if that's the case, then you're going to have to pay a higher price for the next amount of units you want to buy. And then you'll transact here with as many people or as much money is available, but then the demand will drive the market even higher. And this will continually happen, creating a staggered position, which means essentially if you just try to barrel in a huge amount of money at this one given price point, you're actually going to get a very bad average execution because you're going to be buying a bit there, a bit there, a bit there, and a bit there until there have been sellers on the other side of your significant buying order. Okay, so we don't really want to see huge orders going on in the exact same points in the market at the exact same time, because that creates this problem for the institutional traders who are trying to create these transactions. So what we would do instead, or what traders will do instead, is essentially build positions over time. Okay, and that's where we see these ranges coming in. So rather than buying a huge sum as soon as we reach one price point and ended up creating that demand problem that's going to give you staggered orders, you could execute some here, and then some here, and then some here, and then some here, and then some here. And basically over time you've built a large position, but you've done it against the flow of many of the transactions taking place over some time. So when you actually come to essentially placing on the remainder of that position, you're in a position where the market's likely not to jump without you, and you'll be able to benefit by getting into the movement low before the market begins. So that's generally what accumulation or distribution is. It's just the time taken to build significant positions. Now, inside of accumulation and distribution schematics or phases, we are going to see a very familiar pattern, something that we've spoken about in a few of the previous bootcamp episodes. That being essentially liquidity sweeps, or sweeps of highs. So what a general distribution, for the first example, is going to look like is actually something like this, right? So rather than just being a confined range like this one, we are likely to see the market creating a series of highs, essentially like a resistance, or basically just a confined range where we have a clear high or low to it. And then before the final run, before the actual markdown phase begins, so we're looking around this point now, we see a sweep of the high where the market actually runs through what's been created as a support or resistance in this case, taking out liquidity and kind of trapping those traders, that stopping as people like to call it, before the markdown begins. This is that final drive from buyers, which is completely absorbed by sellers. So when we talk about absorption, we're basically referring to what is taking place when buyers attempt to go higher and sellers do not allow it to happen. So if we think about the visualization I've just drawn, this more refined one, this resistance basically creates an area of liquidity or an area of orders in this market. So when we create a range like this, where we have a few different highs all at the same level, general retail and even some commercial banks are going to see this as a resistance point to actually sell. So we will see selling taking place at this level, and this level, and other places inside of this range. And the classic thing for people to do here is to place their stop losses inside of here. We will also have up here buy limits, right? So people placing buy limits so that if the market breaks above resistance, they're automatically triggered into buys because they expect that breaking resistance means the market's going higher. But because there is so many of these buy limits and stop losses, and if we think about what a stop loss is in this regard, it is simply a buying contract. It's an obligation to buy back the contracts at this level, right? Because you've short sold, you sell with an obligation to buy back later, and your stop loss is just the fulfillment of that buy order. So we have loads of buy orders in the form of stop losses in here, and we have loads of buy orders in the form of buy limits in here, which means if the market reaches into here, we see a massive influx of buying into the market, which can be a hyper bullish thing for the market, but it can also be utilized by institutions to absorb all of the buying and essentially take the counter side of that opportunity. So if we see loads of buying opening up here and you want to sell massive amounts of orders, you could do so at this point, right? Because there are so many people buying that you can sell to. So you can short sell the market into all of those open buying contracts, giving a big influx of selling pressure and absorbing the buying pressure. So essentially it's like one final shakeout or false breakout before the market reverses back into the given direction. So through this phase, we see the creation of short sell orders. At this phase, we see the absorption of the remaining buying orders, and then we lead out into markdown from there. And the same goes, but the other way around, like this, for accumulation. So that is what accumulation and distribution looks like, and the theory behind it. Now you could go to any chart that you trade, or any chart you've traded in the past, and you'll see this accumulation and distribution endlessly taking place, okay? Because we do see this. This is why the markets are moving. If you look at any chart, you're going to see ranges, you're going to see phases of upward and downward moving price. That is all the market is, and it's all just moving through this market psychology of accumulation, distribution, markup, and markdown. The market's always building orders or releasing orders. So let's just quickly run through this then. We have a distribution here, generally going to be preceded by a little spike, where we see the absorption of the final buying orders before the market is completely dominated by selling. Then we see an accumulation. A sweep will then lead us into a phase of markup, where the sellers have been absorbed by buyers, and we build some strength and buyer domination. We see some markdown again after this distribution. We see some markdown again after what we call a redistribution. So this would be a point of redistribution where we mark down into a phase of basically collecting and building new short orders, and then we mark down again, right? So it's kind of like a double markdown phase. Markdown, redistribution, markdown again. Then we find accumulation, buyer domination comes in, and then we find re-accumulation. Again, a stall before new buyer domination comes in. Now, the redistribution and re-accumulation schematics, like this one here and this one here, are essentially phases where, say in the case of a redistribution, we see buyers starting to come in around this level, and they try to reverse the market back to the upside, but sellers are very strong. And again, they absorb any of those buying attempts before taking the market lower. So this just shows continued selling domination, whereas a reaccumulation shows the opposite. Sellers have tried to step in, but buyers have absorbed any attempt to take the market lower, and we see a new phase of buyer domination. So this is essentially just a continuation of clear buyer control. So what we're going to do now is head to the charts, and I'm going to show you accumulation and distribution in action in the markets. Okay, so just looking at this chart then, basically the distribution phases are going to be areas before downward moves, and then the accumulation phases are going to be the kind of areas before upward moves, okay? So it's where markets start to top out or bottom out and then move sideways. This is what we're looking for to identify accumulation and distribution. Now this area here obviously shows a clear example of that accumulation and then the sweep before the market runs higher. This phase up here shows the opposite of the slowdown before a drive higher and then a reversal. We see this happen a lot, okay? Now, as we're on a line chart, we do miss out here on some of the information. We're not going to see the wicks, but we get the general idea. It's easier to visualize here on a line chart, okay? So here we have basically a run up, and then we start to accumulate inside of this range. And this is what one of those reaccumulations, because we have markup, reaccumulation, that sweep to the downside, and then we have markup again. Here's another very clean reaccumulation we can see. This phase, we have the sideways price action, the sweep, and then the rally, all right? So this is a repeating pattern up to where price is right now. That is going to be showing you accumulation and distribution and markup and markdown phases. So we're just looking for those sideways phases in the market, all right? Now, obviously, when we look at real charts, it's never going to be always as clean as just this that we would love to see on every opportunity. But it's these examples where accumulation and distribution becomes super tradable, where we have the run of the high and then we look for the reversal out of there to take the market lower. That's what we're really looking for in the ideas of trying to trade accumulation and distribution directly on the chart. But more so than just trying to trade schematics like this, we just want to understand that the market is running in this constant battle between buyers and sellers, where we are accumulating, building positions, and then releasing positions into the market, okay? Even just understanding that puts you one step further towards understanding why the market's truly moving, which is really good for clarity on holding positions and executing positions. So first of all, the main thing you want to take from this is simply those market phases. Why is the market moving? Who is building positions right now? Which direction is the control in? That's what we gather from this. But we are going to look at how to actually trade the ideal formation when it comes up. Okay, so we're going to look at a chart example of trading a clean distribution. Now, as we've said, not every distribution or accumulation is going to create this exact tradable schematic, but some of them will. And when they do, this is where the clean opportunities come in, all right? So what we can see is a phase of markup, and then the market starts to stall out. And this is pretty much the standalone way to find accumulation and distribution phases in the market, is to see the phase where the market's starting to kind of flatline, right? So markup, obviously clear buyer domination. When we see that momentum stall in the market, that's where we really start to identify these shifting phases. So what's actually happening here is through this phase, we have clear buyer control. Around this point, where we see the first slowdown, we are seeing exhaustion from the buyers. So what exhaustion means is essentially the buyers who have been stepping in the market at all of these different levels to drive the market higher are starting to exit positions. And we're starting to see price come into what we could classify as a premium price, which means that sellers who want to short sell the market are starting to step in. So with sellers stepping in to short sell, and also sellers stepping in the form of buyers offloading positions, we start to see less buyer transactions, essentially lower demand. And we also start to see more supply entering the market in and around this level. So with a new influx of supply, selling pressure, we then see a bearish impulse. Now, when the market fails to regain strong buyer domination and keeps seeing these continual pushbacks, it tells us that inside of this range, every time we start coming back up to this high, we see new seller control entering, new selling pressure, and basically sellers at this point are becoming equal in strength to that of buyers, right? So through an up move, we know sellers are a lot weaker than buyers, but through a sideways range, we basically see here buyers and sellers have the same amount of control and strength in this market. That's why we're not managing to get anywhere, because for every buy order, there is an equal sell order coming in. For every sell order, there is an equal buy order coming in. So that's what flatlines the market. And that's what we need to try and read from this. Now, when we see this drive higher, this is the point that really makes it. This is what makes these accumulations and distributions direct tradable opportunities. This in a Wyckoff schematic, now this isn't a perfect Wyckoff schematic, and don't worry about that, is what we call a spring. So I call this a sweep because that's what I call it in any other context. But essentially what it is a notable break above the range that is then reversed with strength by market participants. So we have our pretty confined range, these highs, and what we've seen with this is a drive up, taking out those highs before a quick shift back down, pushing us back towards the lows. So this is that absorption point. This is where we are seeing basically one final attempt from buyers to take this market higher, okay? So we see those buyers coming in force. And then when we get to this point, we see sellers absorbing all of those buying orders. Now, absorption, as we discussed, simply means that basically sellers are taking the opposite side of these buy positions in massive quantities very quickly. So we have a small phase of uninterrupted buyer control, and then that's interrupted by any buys attempting to take here are being taken on the other side enforced by sellers. Now this creates a large influx of supply pushing into the market, and that drives the market lower. Now when the market then breaks through a structural low, such as what we see here with this BOS break of structure, this indicates the shifting point. This is basically where we confirm that this is a distribution and not a reaccumulation or continuation or standard range. Because we see flat line, that's basically equal buyers and sellers, final attempt from buyers, taken over by clear control from sellers, and then closure under a structural low, proving that sellers now dominate this market. Now what you would do from here is look for an opportunity to sell. And that's generally going to come from, in the case of a distribution, the supply zone that created the break of structure. Now it can also come from extreme supply zones. So for this example, you could look way back up here essentially. But it generally, and a lot of times, as you will learn when you are studying this yourself, comes from the zone that creates the shift in the trend, okay? Especially or specifically for the case of a distribution or accumulation. Basically because that is the final point where sellers have stepped in and taken full control of the market. So we see that now as a premium price. Now we know traders want to sell premiums, buyers want to sell at a premium to get maximum for their contracts, and short sellers want to sell at a premium to get the best possible entry and execution for a short position. The higher you can sell, the more profit you make on the way down. So with this now being seen as a premium price, your average trade would look like this. You would enter there, you would target wherever you wanted to target. We're not going to focus too much on that right now. We're talking about the actual schematics. And then you would simply allow the market to return to that level for your order to be triggered. Now this must be imbalanced, okay? We have to see some inefficiency into the supply, otherwise it's not something you would take. But if you get this formation, which you will get at some points in the market, just a clean distribution schematic, that opens doors for you to take a very simple trade out of that range to the downside. And in this instance, your trade, of course, would look like this. So you're triggered in there, and then you get out down there when your target is hit, wherever your target may be. And that is a phase then of markup, sideways distribution, the sweep, the absorption from sellers, the execution, and then a phase of markdown, right? So all you're seeing there is the standard markup, distribution, markdown. That's just one phase of a market, and this eventually will lead into some form of markup after an accumulation or markdown after a redistribution. That's pretty much how the market's always going to move. It's not always going to give you opportunities clean enough to execute in a simple fashion like this, but oftentimes it will. And when it does, That's how you get an opportunity from it. So I'm just interrupting today's episode with a very quick note. What you're learning here in the bootcamp about technical analysis is necessary for good trading. But technicals alone are not sufficient to get you to where you want to go, to profits, to payouts, to funding, all that stuff. See, most traders don't get stuck because of what they see on the charts as much as they think they do. They actually get stuck because of habits, risk behaviors, decision making under pressure, and self-sabotage patterns that form off of the charts that simply don't show up in technical analysis. So I put together a short 15-minute class which is going to change the game for you and help you to diagnose the problems that are stopping you from success that you can't see right now. This is pretty much the reason, or pretty much every reason, that traders lose is in here, and I broke it down fast so you don't have to waste an hour watching it. The link is in the description, so watch that after this class. And with that said, let's get back to the bootcamp. Now here's a clean example of accumulation. We've jumped time frame to the 15-minute here. The previous was the 1 minute. I'm showing you this works across all time frames, okay? So what we have is the selling dominated move, which is just where sellers are clearly in control. There's a lot more supply than demand in this market. We start to see that slowing down at this point. Again, how do we know this is the slowdown? Because we see the first notable buyer pushback. The market then trades into this sideways range. What's happening here? Buyers and sellers are equally weighted, okay? We don't have clear domination from one side or the other. We now have a flatline market. This is the seller exhaustion. So when we see the market slowing down at this point, what we're seeing is sellers exiting. That creates demand for the market because what they're doing is buying back contract. And we also see now that we're at a discount price, buyers start to step in. So we see demand entering, supply dwindling, and that puts us into more of a sideways motion. Now, we then have the sweep, or the spring, that takes place here. This is the point where sellers make their final attempt to go lower and buyers absorb those orders. So all of the selling pressure that gets put in is countered, and we see buying taking force on the other side of that position. This then reverses us back into the range and drives us over the high of the range, creating a candle body closure, which creates a break of structure. If you recall, pretty much what we're looking at here, taking it back to season 1 of the bootcamp if you watched it, and if not, go back and check it out, is the standard confirmation pattern that we like to trade for our positions, right? It's where we shift from lower lows and lower highs into higher highs and higher lows, and then we buy the pullback from open demand and take the market long from there to profit from that movement. That's all an accumulation is taking advantage of. However, sometimes an accumulation is going to be formatted more like a trading range, and then the sweep comes in, but we still need that sweep and break of structure. So realistically, it's the same thing we're looking at. It's basically just seeing where that control is shifting. So that's what we've got going on here. This one in a rather clean and simple standard confirmation phase. When we see that break of structure, we then want to identify the demand that created the break. In this instance, it's going to be this one here, nice and simple. And then your trade would be a buy from here with your stop down there and your targets wherever they wanted to go, anticipating the next phase of markup. So what we would be looking for is simply a pullback. Remember, imbalance is essential, so we need to see that inefficiency. And when that inefficiency is filled, we should see, from what is classed here as a discount price range, we should see new buyers stepping in force as we see that reversal in control from sellers into buyers, because those positions have been built through the accumulation. Okay, so skipping that forward, there we get the tap in, and then we run towards the target, and your position would essentially be that run from there through the new markup. So when these setups do arise, these accumulations and distributions in a clean format, these are absolutely trades that you should look to take, okay? As we say, not every accumulation distribution is going to be clean, but when they are, it's like a free money trade. So let's quickly run through the core takeaways from today's class on accumulation and distribution. And the final, probably the most important part of the video, is the talking point of what I want you to do with the information I've given you. So recapping, the market is always moving in two phases. It's either building orders or it's releasing orders. That's all the market is doing pretty much all the time, okay? The building orders phases are the time it takes to accumulate large quantities of orders in one direction or the other. So it's the distribution, the redistribution, the accumulation, and the reaccumulation phases. In distributions, we are building selling positions. In accumulations, we are building buying positions. The release of those orders is visualized by the phases of markup and markdown. When we see rallies out of accumulation phases, these are markups. When we see declines out of distributions, these are markdowns. So what we are seeing there is building of orders, release of orders, endlessly through the market, okay? Now, as we've just discussed, there are ways to directly trade clean models when we get clean examples of distributions and accumulations, but it's not always going to be the case. And I don't actually want you to treat the trading model that we've discussed today as the core takeaway for today's class. The most important thing, and this might sound a bit weird, and I know most people won't want to listen to this, is just simply understanding the information that accumulation and distribution and the phases that arise because of them actually present in the market, okay? The big factor, the big takeaway here is just a deeper understanding, a deeper clarity as to what it is that is actually driving the market and what it is in terms of buying and selling psychology and actions when you're looking at the markets that you trade. Now, I know on the front end, that doesn't sound like it's going to translate into more profits for you. So for a lot of people, you won't be interested because you want patterns, you want easy ways out. But honestly, having clarity around why the market's doing what it's doing will pay you more over time, because you're going to have confidence to hold positions and you'll have a lot of conviction behind the trades that you do take, meaning you're not going to hesitate out of trades because you don't really know what it is you're looking at. You'll be able to hold with confidence, understanding that what you're looking at has some context behind it, and you understand why it should be going up or why it should be going down. So when you see trades aligning with accumulations and distributions, you'll be happier to hold those. And that over time will compound into significantly better results than what you're getting now. Just the clarity, confidence, and understanding of why the market is doing what it's doing is so valuable, even if it doesn't directly relate to results. It will subliminally create results in the background. The big takeaway is just clarity. It's a deeper understanding. And it's, again, the why behind the market, okay? That's what we really want to draw from the understanding of accumulation and distribution. And hopefully, I've gotten that across to you today in this bootcamp episode by showing you why the market moves like this and why distribution and accumulation and the phases that come between are so valuable to understand, because these are really, alongside supply and demand, I mean really as a derivative of supply and demand on a broader perspective, the reasons why the market move. So with that said, hit the link in the description to check out the trading diagnosis class. Thank you for watching, and I'll see you in the next episode of the Bootcamp.